Imagine waking up one day and realizing your money lost value overnight. You still have the same number in your bank account, but suddenly it buys less food, less fuel, and less comfort. That silent thief is called inflation. Inflation doesn't break into your house. It doesn't steal your wallet. Instead, it quietly reduces the purchasing power of every dollar you save. A famous investor once said that inflation is like a tax you pay without a law being passed. It slowly erodes the value of your money without most people noticing. Many people think saving money in the bank is the safest financial decision. But if inflation rises faster than your savings interest, your money is actually losing value every year. Imagine you saved $10,000. If inflation is 5% per year, the real value of that money will shrink dramatically over time. This concept is known as purchasing power. Purchasing power means how much goods and services your money can actually buy. Over the past century, inflation has reduced the value of money dramatically. What $1 bought 100 years ago might require $20 today. The problem is that inflation works slowly. Because the change happens gradually, most people underestimate its impact. A well-known finance book explains that money sitting idle is like ice melting in the sun. It slowly disappears unless you protect it. Inflation affects everything: food, housing, healthcare, transportation, and education. Almost every part of daily life becomes more expensive over time. When prices increase but your income stays the same, your financial freedom slowly decreases. This is why simply saving money is not enough. Financial literacy requires understanding how to grow your money faster than inflation. Many successful investors emphasize one powerful idea: money must work for you. Instead of letting cash sleep in a bank account, investors put money into productive assets. Assets are things that generate value over time, such as businesses, stocks, real estate, or productive investments. One famous investor explained that owning pieces of great companies is one of the best protections against inflation. Why? Because businesses can raise prices as inflation increases, allowing them to maintain profitability. This means owners of businesses often benefit from inflation instead of being harmed by it. Another concept often discussed in financial education is the difference between saving and investing. Saving protects money for short-term safety, but investing protects money from long-term inflation. For example, keeping emergency funds in cash is important, but long-term wealth requires investment growth. Historically, stock markets have grown faster than inflation over long periods. This is why many retirement plans around the world rely heavily on diversified investments. Diversification means spreading your investments across different assets to reduce risk. Another powerful protection against inflation is owning real assets. Real assets include things like real estate, natural resources, and infrastructure. These assets tend to rise in value when inflation increases because replacement costs become higher. Inflation also benefits borrowers in certain situations. If you borrow money at a fixed interest rate, inflation can reduce the real burden of that debt over time. However, uncontrolled inflation can be dangerous for an entire economy. When inflation rises too quickly, it can destroy savings and create economic instability. History provides many extreme examples where inflation spiraled out of control. In those cases, money lost value so rapidly that people rushed to spend it immediately. Fortunately, most modern economies attempt to control inflation through monetary policies. Central banks usually aim to keep inflation around a moderate level. A small amount of inflation encourages spending and economic growth. But too much inflation reduces financial stability and damages long-term wealth. For individuals, the most important defense against inflation is financial education. Understanding money gives you the power to make smarter financial decisions. Instead of fearing inflation, you can design a strategy to outpace it. One simple rule used by investors is this: grow your money faster than prices increase. This often requires patience, discipline, and long-term thinking. Short-term market fluctuations may feel scary, but long-term investing has historically rewarded patience. Compounding plays a crucial role in defeating inflation. Compounding means your money earns returns, and those returns begin generating their own returns. Over decades, compounding can turn small investments into significant wealth. This is why many financial experts encourage starting investments as early as possible. Time in the market is often more powerful than timing the market. Another important strategy is increasing your income potential. Skills, education, and career growth help your income rise alongside inflation. People who constantly upgrade their skills often outpace inflation through higher earnings. Financial resilience also requires maintaining good spending habits. Avoiding lifestyle inflation helps preserve more money for investing. Lifestyle inflation happens when spending increases every time income increases. Instead of upgrading everything immediately, invest the difference. Small, consistent investments can create powerful long-term results. Inflation may be silent, but knowledge is powerful. The more you understand money, the less power inflation has over your life. The goal is not just to save money, but to protect and grow its real value. Remember this simple idea: inflation never sleeps, so your money should never stay idle. Thank you so much for listening. I hope you enjoyed the video. The next episode is on its way, so make sure you're subscribed so you don't miss it. Stay tuned.